The Federal Reserve and the Bank of Japan's policy decisions were the major highlights of last week. The FOMC sounded a bit too dovish in comparison to what's going on in the world, hence the US dollar sold off following the FOMC meeting, as traders didn't buy into the FOMC's optimism. Now, the Bank of Japan expanded the annual exchange-traded funds buying program from 3.3 trillion yen to 6 trillion yen, yet refrained from cutting the interest rates and inflating the size of its 80 trillion worth of bond buying program. The status quo in rates and the bond buying program caused some disappointment in the market. The dollar-yen sold off to 102.68, and a further decline towards the 100 level is well on the table. However, the upside risks prevail as the government is now expected to announce an impressive fiscal stimulus package to counterbalance the post-Bank of Japan dissatisfaction across the market. The latest news suggests that the government is on a 28 trillion yen spending program, including a sizable 13 trillion yen worth of low-interest loans. Last Friday's fall in the dollar-yen could therefore be an interesting buy the dip heading into the next week. Next week, we will be talking about the final manufacturing and services PMIs across the globe. China, Japan, Europe and the UK will all be in focus. Now, of course, the latest numbers for the UK attracted a lot of attention and also created some tension, as data suggested a painful post-Brexit era. The pound underperformed its G10 peers last week. In fact, the weaker US dollar has only been an opportunity to sell the rally in the pound. The 130 level is right around the corner for a potential sustainable stay below this level. Now let's talk a bit more about the pound. Although the UK's so-called Super Thursdays tend to be a little bit of a flop, next week's could be hiding some surprises. Now, we call it Super Thursday because the Bank of England will announce its monetary policy decision and reveal its brand new post-Brexit economic forecast via the quarterly inflation report. Now, the market sees the 25 basis points cut in the bank rate as granted, as the Bank of England will certainly revise the growth forecast on the downside following the Britain's decision to leave the European Union. Now, the Bank of England is expected to highlight the rising recession risk due to the murky business and trading environment. The amplitude of the revision in forecast will be the decisiveness on the pound's value. Again, we are prepared to see a sustainable slide below the 130 level against the US dollar, simply because the post-Brexit comments from the Bank of England Governor Mark Carney have been somewhat dark. Now let's travel to the other side of the world. On Tuesday, the Reserve Bank of Australia will be under the spotlight. Now, the RBA is also expected to cut the cash rate by 25 basis points to 1.5%. The Aussie dollar has firmed over the last week, yet the Fibonacci's 38.2% retracement on June 24th to the July 15th rise at 0.7533 has acted as a good short-term resistance. Now, should the RBA meet market expectations and, of course, leave the door open for further action, then we could see a break below the 0.7421 level for a further sell-off towards 0.73 or 0.7250. In the alternative case, the other scenario is a potential dissatisfaction with the RBA, which could send the Aussie dollar to the bullish consolidation zone, with the possibility of a recovery towards the 0.7675 level, a July high. Now that's all for the week ahead. Tune in next week, but for now, have a lovely weekend and goodbye.